All right, welcome back to your ongoing pursuit of your Bachelor's of Multifamily Science here at the Apartment Academy. This is part 2 of our discussion surrounding financials here in the multifamily industry's only operations-focused podcast, where we feature insights from industry leaders, investors, vendors, and technology providers, or in this case, insights from yours truly. And so if you invest in multifamily real estate or you're involved in day-to-day on-site operations of apartment buildings, we're your source for efficient operations and maximizing NOI. So last time we were talking about, in part 1 of 2, the typical financials that you expect to encounter when you're operating an apartment building and some of the meanings behind some of the definitions and numbers that you see. And we sort of wrapped up in part 1 talking about the income statement, all the definitions on the income statement. And I want to talk about now kind of a subject that affects how that income statement looks. And that is whether or not your property follows accrual or cash accounting. Now, I'm not an accountant, so everything I'm going to speak to today, everything that I spoke to in part 1, all of this I'm trying to just use, and I am using just layman's terms to talk about these things. And the same is going to apply here to accrual versus cash, because that's how I understand it. And I think it's the easiest way to explain it to you, the Apartment Academy listener. So your property, your owners will elect to follow either accrual or cash accounting. Let's start with cash. Cash accounting is very simple to create. It's very simple to understand. When somebody pays you rent, if you get $5 in rent, you put it on your income statement that I received $5. When you pay an invoice and you pay somebody $5, you put that on your income statement on the expense side that says I paid $5. And if that's all you get for the month, at the end of the day, you earned $5 in rent, you paid $5 out in expenses, you have zero net cash flow for the month. Okay. It's very easy to understand. But there are some downsides to that kind of accounting. And the downside is that expenses can vary wildly month to month, and any given month may not represent kind of what the average expense should be. And you might be understating or overstating your cash flow for that month. And that's meaningful if you're, first of all, a lender who's trying to understand what they can expect, what kind of cash flow this property should expect to receive over time. And it's also deceptive to investors who might think their property is throwing off more money than it should because you forgot to pay a utility bill, which will in cash accounting will increase your cash flow for that month. Accrual accounting accounts for that. So one very common thing that gets fixed in accrual accounting is there are utility invoices that sometimes only get paid every other month. If you're using cash accounting, your all other things being equal, your cash will go up 1 month and down 1 month and up 1 month and down 1 month just with the payment of utility bills. And you've got to figure out which one of those months represents the actual like projected cash month for the next month. And you've got to go through, I mean, if you could just average it and say, okay, well, on average, accrual accounting takes that out of the equation. So where in a cash accounting, you count money when it's received and you count expenses when they're paid. In accrual accounting, you count income is recorded when it's earned. Okay. So that means that somebody owes you that $5 in rent. That may or may not have paid it to you yet, but because it's owed, it gets booked on the income side on your income statement. Okay. And expenses are recorded when they're incurred, but not when you pay them necessarily. So even though you didn't receive a gas bill this month because it's only paid every other month, you incurred a gas expense. You may have to guess at what that is, but accrual accounting demands that you register your actual expenses incurred on any given month. Or that if you pay something for the entire year, let's say you pay your insurance up front for the entire year, 1/12 of that expense actually belongs in the expense of every single month. So you might have paid it in cash up front, but you're actually only going to recognize 1/12 of that expense every month over the coming year. This normalizes your financial outlook for that property. It is why investors and specifically lenders want to see accrual accounting. It's more difficult. It's more timely. You have to, if you didn't get an invoice, you didn't get a bill that you expect, you have to remember that, and you want to go ahead and book it as if you received it anyway. So there's a lot more management to it. But what you end up with is an income statement that at the end of the day is more meaningful. Okay. But you're going to need the cash flow statement to really fully understand the actual cash that went into your pocket at the end of the day. Whereas when you're using cash accounting, the bottom line of a cash accounting income statement is generally the cash that you're left with at the end of the day. The income statement for an accrual property, whatever it says is net cash flow at the end of the day or free cash flow, might not be the actual cash that you walked away with, that you put in your pocket. So you need the cash flow statement to understand what actually happened at the property on an accrual basis, because the cash flow statement will do things like, if you anticipated, hey, I didn't get my utility bill this month, but it was about $15,000 on the accrual side, that will reduce your revenue by $15,000. It'll count as an expense, but you didn't pay that bill. You're just allowing for it. You're accounting for it. You actually still have that $15,000 in your pocket. So your cash statement will reflect that, like the things that you accounted for, but didn't actually use your cash. It will also do the reverse. It will account for things that you accounted for that you received cash for, but you didn't actually get that money. So you might be owed rent from a unit. They might owe you $5 in rent. And on the income statement, it's going to reflect the amount of rent that was owed to you. But if they didn't pay you that rent, you don't have that cash in your pocket. And the cash flow statement will reflect that. The cash flow will adjust and it'll say, all right, you said you were owed $100,000 in rent. $15,000 worth of rent was not actually collected. So it's going to subtract that from your bottom line to adjust down to an actual cash number. Okay. And that's the purpose of a cash flow statement, is to take your income statement and adjust it to an actual cash number. A lot of times that's the same as a cash income statement if you're doing cash accounting. But if you're doing accrual accounting, you're going to need the cash flow statement to adjust down to a cash number. One other thing I want to point out about accrual accounting is that the expense of a debt service, the principal piece of that, is not on your income statement. Only the interest is reflected as an expense of the property. The principal piece that you pay is a retirement of a liability. And a liability is on your balance sheet. So if you owe $1 million to the bank, right, and your payment that month is $20,000, $19,000 of which pays interest, $1,000 of which goes against the principal, the $19,000 will show up on your income statement. The $1,000 that you pay that goes to principal will go onto the balance sheet. It will reduce your balance from $1 million to $999,999, whatever that is. And so that reduction in principal payment and principal balance is reflected on the balance sheet, but also the $1,000 that went to that is a use of cash and shows up on the cash flow statement. I hope that makes sense. But it is one of the things that often tricks people when they look at it at an accrual income statement and they say, oh, I made $3,000 this month. What they don't realize is, no, they had to pay that part of the debt payment is missing from the income statement. Part of that debt payment is on the cash flow statement, the principal piece. And actually they lost $2,000 that month because they had to pay $5,000 that went to pay down principal on the debt service. But again, the benefits of accrual accounting, getting properties refinanced, giving investors predictable income that they can look and predict cash flow shortages or distributions. You can't do that reliably on a cash income statement. You need to use an accrual income statement. Cash is easier. It's a lazy way to do it, but it's not as insightful. So keep that in mind. So now let's talk a little bit about the three different statements and just how you need to be looking at them on a monthly basis. We've talked a lot about the income statement and the things that are on there. What should you be looking for on a monthly basis when the financial statements are produced? They want you to review them. What are you looking for? First of all, very simple tip number one, use the trailing 12 income statement to review any given month's income statement. Use your trailing 12. What the trailing 12 means is it shows you for the prior 11 months, for every line item, it shows you what your income and expense items were. And it's the easy way to pick up anomalies. You're looking for anomalies. You want to look across the vacancy loss item. You want to see that the vacancy loss is more or less the same. If this month something has a big vacancy loss number, that's a red flag. You want to pick that up. You also want to look at I'm now going to talk mostly in terms of accrual accounting because that's, if you're a professional manager, you're probably dealing with accrual accounting. You want to look to see that loss to lease is being reduced over time. That means that as units are rolling, you are achieving market rent for those units. And so the difference between your market rent and your in-place rents is slowly narrowing. So you want to see that go up. That all happens better in comparing a 12-month trailing statement than it does looking at an individual income statement on its own. Same thing goes for the expense side. You want to look at expenses. You want to see more or less pretty much steady state expenses in things like utilities. You'll see seasonal changes for sure, but you don't want to see big spikes. You don't want to see big spikes in the water bill, because if you see a big spike in the water bill, it means you probably have a water leak. And that's the kind of things you want to be scanning for. In unit turns the expense for unit turns, that's going to vary wildly depending on how many, units you have rolling in any given month. So it's common to see that vary. You want to make sure you want to look at your line item where you're showing resident charges. When a resident moves out, you should be charging them for damages. If the line item for resident charges is zero in any given month, it could mean that somebody forgot to charge a resident who is moving out, damage charges. And there is always at least cleaning charges, and there's oftentimes damage charges. So that line item shouldn't really be zero. You want to look at, debt payments and taxes. These should be fairly steady. If those amounts went up, if it's the end of the year and your insurance rates go up, you want to make sure that you see those go up and that somebody's not still carrying the same accrual that they were carrying before and forgot that you're into a new insurance year and that rates have gone up. So using that trailing 12 to look for anomalies is really important. So on the cash flow statement, you're going to look for odd uses of cash. First of all, your capital expenditures will all be on the cash flow statement. So you want to make sure what you're seeing there represents what you believe to be an appropriate classification of those expenses. You don't want to generally see just regular maintenance items being capitalized. That's usually not appropriate. Again, you can't have owners and investors, as we talked about in part one, who want you to capitalize as much as possible because they want to make the property look very profitable in any given month. You can see them trying to hide things by capitalizing it. And also you want to make sure that if you've had any big major expenses or replacements like boilers, HVAC equipment, you want to make sure that that's showing up there in the cash flow statement. It wasn't accidentally expensed on the expense side. Again, unless you have an investor or an owner who is asking you to try to carry as much on the expense side as possible. You want to look at accrued trade payables. That those accrued trade payables line items is an indication that bills that aren't getting paid. And so if your accrued trade payables is going up, it means somebody's not paying bills. You won't see that on the income statement. It'll look fine, but only the cash flow statement will tell you that the property is not paying its bills. You want to look for delinquent rent. So if delinquent rent is going up, it means that somebody's not collecting rent. Just realize that the delinquent rent number on the cash flow statement is the net of uncollected rent from the prior month that was collected versus against rent that was due this month that was not collected. So the difference you're seeing on the cash flow statement is the net of those two numbers. Just remember that. And then on the cash flow statement, last thing is you want to look for, if you have a loan, you want to make sure that the debt payment, the principal piece of the debt payment, is being accounted for on the cash flow statement as well. Finally, the lonely stepchild of the three financial statements is the balance sheet. I've rarely met a property manager or even a regional property manager who's looking at the balance sheet. But there are a few important things on that balance sheet that you need to be aware of. So the first thing to look for on a balance sheet are your security deposits. When you receive a security deposit, it is not income. It should not be reflected on your income statement. It is essentially a liability. You've got to give that money back to somebody at some point, less whatever damage charges you're going to assess. So your security deposits that you have collected should be there on your balance sheet. The liability for security deposits that you owe should be there as well. And you want to make sure that you have enough security deposits to cover your security deposit liability. I've seen a lot of properties that get in financial difficulty, and the owner, rather than contributing capital to cover, any operating deficits, instead the owner uses their security deposits as operating capital. That's a terrible idea, but it happens. And if it's happening, you will see it on the balance sheet because you will not have the security deposits reflected there to cover the liability that should be there. So on the asset side should be security deposits you have on hand. On the liability side should be the liability of security deposits that you will in theory owe when people move out. That's the first thing to look for. You also want to look for your unpaid rent. So the unpaid rent represents an asset. It is money that you still expect to collect. But every month that somebody doesn't pay you rent and you don't collect it, that unpaid rent is going into this bucket, this unpaid rent bucket, because until you say differently, the financials expect that you're going to collect that rent at some point. So that number can grow substantially and represent an asset of the property, in that case being money you expect to collect at some point, that isn't real. These people have moved out. They're never going to pay the rent that they owe you for whatever reason. And so you need to at some point write that off of your balance sheet. You should make that decision on a monthly basis. How much of the rent that's reflected on the balance sheet is uncollectible, and write it off so that number doesn't become a large number. Just remember that when you write it off, that write-off then becomes an expense because you have to reduce your income item that you said you were going to collect a month, 6 months, or a year ago. Now you're going to write it off, so it will go onto your income statement. But you need to look for that. You want to make sure that your security deposits and that your unpaid rent are in line with your expectations. Other things you can look for, you want to look for just to make sure that the principal balance of your loan is correct. You want to make sure that any capital contributions that your owners may have made is reflected properly. So just a cursory review of the balance sheet on those items is probably enough. We could talk a lot about some other things that show up on the balance sheet, but that's what I think you really need to be focused on, when you're on the operations side. Okay, so we've been through the high level of the other financial statements. Let me just leave you with some other metrics that you want to be thinking about as an operator, and you want to be aware of and tracking month over month. So occupancy, of course, obviously. Economic occupancy. Economic occupancy is a very interesting and compelling number that you're going to want to calculate every month. To illustrate economic occupancy in a overly simplistic fashion, you might be 100% occupied. But if 50% of those people are there because they received free rent that month, your economic occupancy is only 50%. You're only receiving rent as if 50% of the people were paying or occupied because only 50% of them are paying. So that's economic occupancy, and it can reflect the impact the concessions are having on your financials. Percent leased, the leased percentage to me, the way we've always spoken about it is not the same as percent occupied. Percent leased is a trend. Percent leased looks at what your occupancy is today, how many notices you have coming up of people that intend to leave, and how many of those are pre-leased. So it's looking 30 or 60 days down into the future, say, what is my future occupancy looking like right now? What percent leased am I? Another great metric that everyone should be looking at. Effective rent versus rent. So effective rent is kind of the actual rent that you're receiving when you take into account concessions. So your monthly rent might be $1,200. But if you've given them a 1 month concession, you take that of $1,200, you divide that over a year. So $100 a month. Your actual effective rent is not $1,200. It's $1,200 minus $100. So $1,100 a month is your effective rent. That's important to track, your effective concessions as well. Your lease renewal percentage. So when a unit comes up for renewal, what percent of those units are renewing and are staying with the property? Most owners want to see something very high, right? You want to see above 60%. Some owners want to see something very high. Some owners will really be pushing rent. Some operators will want to really push rent, and because it's a hot market. And in that case, your lease renewal percentage may go down, and that's okay with everybody. But everyone should be on the same page with what your expectations are, and it should be tracked. Debt coverage ratio, we talked about that. Debt coverage in session 1, debt coverage ratio is the ratio of your NOI to your actual debt service, and it should be greater than 1. If it's less than 1, you're in trouble. If it's less than 1.1, you're probably in trouble, or you're very close, and you might be in violation of debt coverage covenants that the bank is looking for, and you're at risk of the bank instituting protectionist measures that could include, for example, forcing you to deposit all of your rents into a lockbox so that they take the rent and pay themselves first and then give you the rest for expenses. So you want to watch your debt coverage ratio. Delinquency percent, of course, 3%, 5% delinquency is generally acceptable. You want to track your lease expiration curve. You do not want 100% of the property all checking out in December. You may want more people checking out in the summer than you do in December. So you should establish what your desired lease expiration curve is so that you can set your lease durations based on trying to fit that lease expiration curve. There are a number of marketing analytics you want to be tracking. What for each one of your advertising sources, how many leads are they throwing your way? What are you paying them for those leads? So your cost of each lead, you want to be tracking that as well. And lastly, resident satisfaction. You should be surveying your residents on a regular basis. You may even be surveying employees, and that's becoming more and more important, and tracking resident satisfaction. Resident satisfaction is a precursor to retention. So you want to make sure that residents are happy, and regularly performing a resident satisfaction survey allows you to get in front of any problems before the resident gives you a notice. So all of those items, ideally, you're producing every month. And if you do that, you will have a very good picture of the health of the property that goes beyond just the financials themselves. So I hope you took good notes on all of that. But as you say, look, the only test you'll have is awaiting you in the leasing office every day back on site. So we appreciate you joining us for part 2 here of our financial discussion here at the Apartment Academy. If you've listened to these podcasts and you feel like your management company could use a little advice from some of the professors here at the Apartment Academy, then go to our website, apartmentacademy.com, and click Help Me. We'll send you a questionnaire and provide individualized responses to your answers at no charge that I guarantee will offer you insights on ways you can immediately improve apartment operations. Thanks again, and I look forward to joining you again when class is in session.